This chart captures Bitcoin's price action and leverage density on August 23rd. The vertical drop seen here drives price into a high-density cluster near 76,000. At contact, the bright horizontal bands are erased as orders are consumed. A move of this scale is the result of mechanical order book balancing. The volatility is a byproduct of how these specific orders are executed. When the price approached the $76,000 mark, the high concentration of leverage at that specific level made a move into that zone a structural probability. Large-scale price cascades are the result of identifiable structural fragilities. These conditions can be tracked and analyzed in the data days before they actually trigger. To understand why this happens, we are going to reverse engineer this specific cascade by analyzing the 72 hours of leverage accumulation that preceded the crash. This process relies on liquidity magnetism. Market makers require high volume to fill large requirements, and price is naturally drawn towards these clusters of forced orders to satisfy that demand. On a liquidation heat map, the brightness of the band represents the volume of capital at risk. Dark purple indicates low interest, while bright yellow signals a massive concentration of capital at that specific price. Because price movement is constrained by the availability of liquidity, these heat maps function as maps for near-term price direction. Identifying a support level requires more than just looking at a price floor. It requires understanding if that floor is built on organic buyers or fragile, forced selling liquidity. On August 20th, the market began a new cycle. Price action trended towards 70,000, specifically targeting the thin blue and purple liquidation bands sitting just above the current range. This chart shows the result, an aggressive rise towards 74,000. As price consumes those topside bands, it leaves behind dark, empty space on the heat map where the shorts were cleared. This clearing of shorts creates an asymmetric order book. Resistance above is now thin, while the potential for high leverage positions to build below increases. This upward momentum typically leads to trader complacency. As price holds its gains, traders open aggressive, high-leverage long positions to chase the trend. The upward movement on August 20th provided the incentive for this over-leveraging, setting the stage for the eventual downside flush. Moving into August 21st and 22nd, price stabilized and moved sideways near 79,000. This chart shows a prominent yellow band forming just above that price point. Below the horizontal price action, the microstructure was shifting. High-density liquidation bands were quietly building just beneath the market. These bands eventually hardened. In this chart, you can see the risk transitioning from speculative green into two high-intensity yellow support zones sitting directly under the price range. These bands represent late-stage long positions. Traders entering near the local top using maximum leverage effectively stack their liquidation triggers into a very narrow price window. This creates structural fragility, a state where the volume of potential forced selling far outweighs the depth of organic buyers. While the price appeared stable on a standard chart, the order book was becoming structurally insolvent. It only required a minor trigger to collapse. A chain reaction is triggered the moment a price candle intersects the first layer of a dense liquidation cluster. Forced sells hit the existing bids, which drives price lower into the next layer of liquidations. This triggers more forced sells, creating a self-reinforcing loop. This is a mechanical process. The exchange matching engine is designed to close insolvent positions as quickly as possible to protect the system's integrity. This feedback loop is why these cascades move vertically. The order book is effectively consuming its own liquidity to clear the debt. Returning to the heat map just before the final collapse on August 23rd, price lost the 78,000 boundary. This left the yellow band above as a new ceiling of resistance. This chart captures the drop into the 76,000 cluster identified earlier. The concentration of liquidation orders here fueled the acceleration of the move. Following the purge, the price action stabilized. The bright bands of risk have been cleared, and the volatility has subsided. This purge reset the order book, returning the market to structural balance by clearing the leveraged debt accumulated over the preceding 3 days. This cycle is repeatable. Momentum clears the existing shorts, consolidation builds new clusters of long leverage, and the resulting fragility leads to a purge. In markets dominated by derivatives, liquidity density is the primary driver of price action. Autopsies of events like the August 23rd flush demonstrate that most major market moves are visible in the data well before they occur. Effective risk management requires calibrating your positions to the proximity and density of these leverage heat bands. In the world of Bitcoin perpetuals, you are either the one reading the heat map or you are the liquidity on it.